Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions, generally related to three different topics: wealth building, commodities, and/or financial topics. So I'm going to dive right in, take a look, and see what people are sharing. If you want to follow me at Finance, if you want to join our community, finding-value.com, where I dive deeper into all of these topics, looking for potential investment opportunities in the markets. Mayday coupon code, MAYDAY coupon code, if you are interested in joining. Correlation economics. He says another gold up, oil down day. Just how I like it. Gold is generally what leads the markets, the commodity markets. Oil follows, but it follows with a lag. So one thing that you can look for is you can see how these things fall. Gold is the green, oil is the blue, and then you can see the lag behind. It lags by 12 months, 18 months, something like that. So you can see this big move there. That is this big move here. And then you can see how it moves through time and how it moves. And now it's not going to be perfect. And there are going to be times where it could potentially disconnect, like we had in 2018 through 2020. We are going through something similar, I think, with that disconnection here in the short term. And what it's doing is gold's ripping to the upside while oil is holding flat at this exact moment. We are somewhere probably back in this era here where it's delayed. So this portion there is probably this guy here. And we're probably going to get this one last little flush out before a big move to the upside. This ratio of gold to oil is at incredibly low levels right now, where oil is incredibly cheap. So if you're a value investor, what I would be doing is I would be looking at oil equities to see where the value is. And I'd be combing through developing strategies of what I might want to purchase over the next few months. Because that's where the value's at in the market. And when this gets larger and larger between gold and oil, this gap, that means your ratio is getting more favorable for oil. Now, could this ratio blow out for a period of time? It could. We could see a big divergence where this drops and this goes up based off the market conditions. And then when the market conditions of a quote potential slowdown and the worries get behind us, that is your opportunity. So you have to do opposite of everyone else if you want to make monies, and you got to look for those opportunities in the market. So what I think is coming is this guy here, this move lower, is this move lower behind it. This guy here, this move lower, is probably what's going to materialize here in the short term before the move on up. I don't think it's going to be some blowout crash. It didn't go down that much, but it could go down a little bit in oil. And that's kind of gold front running what oil is doing. Ross J. Brown says lumber company Louisiana Pacific hits a new all-time high this morning. Now, that isn't something that you see if we're going into a housing recession. A lot of guys calling for a market top in the housing market, and we don't see lumber making new all-time highs. Lumber is a leading indicator where if more homes are built, more lumber gets pulled. It's in manufacturing, we call it a pull system. So if there's more demand on the back end, it pulls the supply from lumber. So it pulls all that towards the home builders. So that's not a bearish situation here for the housing market. It's bullish. Eric Young says, "Holy moly, there you have it, folks." So Saudi Arabia, once a pillar of the petrodollar system, may be secretly amassing gold reserves as central banks worldwide quietly buy up the precious metal. So Saudi Arabia, maybe it's buying up metal. That's the most recent news there. Fed's Kashkari says the balance of risks have shifted towards risks a future labor market weakening and higher unemployment. So that's why they're lowering rates. And that is also one of the leading indicators for a potential slowdown. If we see a large move in unemployment to the upside, where we get a spike in unemployment, that almost always mirrors a slowdown. Now, here's another thing that I want to talk about. In 2022, we had a slowdown, and one could argue that we already went through a recession and a slowdown. That slowdown was felt by gold. Gold going down in 2022 right here. That was the slowdown. And now we're coming out of the slowdown already. So gold is a front runner, and people may be looking at yesterday's news when it comes to some of this stuff, but there still could be a lag. We could still see it, and it's something to watch. I'm going to skip through that one. Happy Hawaiian. There are only 111 homes for every 100 households. This is not a record low, but it's not far from it. Goldman knows what they're talking about when they say we need more supply in terms of homes. So it's not the record low going all the way back here to 2000, 2001. We're pretty low here for that metric. Samantha Leduc says scary high. And again, this is US equity performance versus the rest of the world. When I see charts like this, guys, it's time to go with global equities and not US equities. Whenever you get out of this in terms of the standard deviation. So basically, this is your mean going across, and then you have standard deviations on either side. This is like a 2 to 3 standard deviation move to the upside. So this is most likely going to come back down at some point. That's what I would bet on. It's your asymmetry. Last time we went, it was like this in the 1960s, which it's the same situation as what we have today. It's a very similar situation and setup. I think we're going to go into a commodity bull market. We went into a commodity bull market shortly after this turned lower. So I think this will turn lower here, probably at some point, much like this guy here. We also saw that in 2000, 2001, the internet bubble, and then we went lower, and that was the other commodity bull market to 2011. So I think we're going to have a big commodity bull market coming, and everyone's off sides here. They're all in U.S. equities at the moment. And that's a lot of money rotation. And the weird thing is, some people say the more you get to the upside, the more that you could potentially reverse and go to the downside. So we could go all the way down here, which is a possibility. Agree and disagree. It says, I'm fairly convinced that if you leveled the playing field and gave everybody $25,000 to start, then within 5 years, most of the people who are currently rich would be rich again, and those who are currently broke would be broke again. Not all, but most. Totally agree. I totally agree. It just deals with growing it and habits and the skills that the people already possess. Money isn't the opportunity for most people. The opportunity is the skills that they've gained and the knowledge that they have. And if you just take money away from savers, they're just going to save it again. And if you put money in the spender's hands, they're just going to spend it again. So it's personality traits, skills that people possess, all of those things. And I would agree. Warning, buying conditions have collapsed, now reaching levels only seen 2 times since 1960. 74 and 81 both ended in recession. So people don't feel like buying homes. The only thing I'll say here is we're at a really low level already. So are they expecting this to stay down or go lower, or is this going to come back up? If it comes back up, I mean, wouldn't that mean that we are coming out of a problem? Because when this came back up, that came out of the problem. So if we're already at the bottom here, the move already occurred. Like this move lower is the slowdown. Now we're consolidating and ready to actually strengthen. So when people read these charts, I think they're misreading it. What you want to see is you want to see like a high point to a low point, and the movement as you go is the slowdown, so to speak. When you come from a low point upward, that's a strengthening of the market. Gergen says total with U.S. rigs is down 2. Oil unchanged, gas down 1, miscellaneous down 1. Total rigs are down 42 year over year. Here is the U.S. Baker rig count. There it is in the upper left. You can see the big 3 hump consolidation that we're doing. And sometimes we don't get a third hump. It'll break to the upside. You can also see U.S. weekly crude oil production per rig. So we are getting more efficient at extracting this, or we are going after better tier acreage. U.S. Baker Hughes natural gas rig count, you can see it's way down there since 2016. Kobayashi letter says Americans have never been so worried about the year ahead. The share of consumers uncertain about business conditions over the next year spiked to 51% in September, the most on record. The percentage has doubled in 4 months. Over the last 30 years, the share of consumers concerned about short-term business prospects have never been so high. Americans have been hit by historically high cost of living, elevated borrowing costs, and the deteriorating job market. U.S. households are struggling. This is clouded prospects. Consumers are seeing unprecedented uncertainty in the year ahead. That is a huge breakout, though. I mean, look at that. This is share of who are uncertain about short-term business, and that's like a massive breakout going back all the way to 1994. I mean, this is pretty small movements, and then this thing is absolute hockey stick. So we'll see what happens going forward. I just saw this chart and said, wow, that's like a big breakout. Like something's going on there. Natalie says, am I crazy or did oil changes used to be like 35, 40 bucks? I paid $119 for one yesterday. This is what I'll say about oil changes. So I do my own oil changes. The cars that I have take less than 5 quarts. Two of them take 4 quarts, the Civic and the Aveo. Actually, they all take less than 5 quarts. The rotaries take, 4 or 5 quarts, somewhere in there, 4.5, 4, something like that. The oil costs $20 for synthetic oil. Full synthetic oil costs $20 at Walmart. You can buy oil filters off of Rock Auto for a couple bucks each, like $2 to $3, depending on which ones you buy. So for an oil change, the actual cost is going to be, let's just call it $25 total. For an oil filter, oil, and it takes one bolt on the bottom of your oil pan, and you have to undo your oil fill cap. That is all that it takes. If it does cost $119, basically you're saving $100 to change your oil. When I change the oil, and here's the reason that I change my own oil. One, I want it done correctly. Two, I want to make sure that the oil level is correct. Three, it's faster for me to change my own oil than it is for me to get in my car, drive it somewhere, sit in the stupid little spot and wait for someone to change it, have them mess it up, and then come home, pay a bunch of money, and then have to fix it again. So it takes me maybe 20 minutes, and it's super easy to do an oil change on your car and to change the filter. Some cars are a bigger pain in the butt than others. Others are incredibly easy. The cars that I own are incredibly easy. And there's a reason I purchased those cars because I purchased them because the oil changes were very easy. That's one thing I do look for when I look at vehicles. How easy is it to change the oil? And most of the time, I am satisfied with a four-cylinder car because oil changes and spark plug changes and maintenance is infinitely easier than a V6 transverse mounted sideways, front wheel drive car with a V6. Sometimes those are a big pain in the butt because they're a lot more crammed in there. So I think about all this stuff when I go and I buy a vehicle. I think about maintenance. I think about reliability. I think about how easy is it for maintenance on everything. Investor Wisdom says good investors are data driven and enjoy the game. They are people doing what they love doing. It really is a game they love, says Warren Buffett. HFI Research says even the GOM gas production coming back, lower 48 gas production remains below 102 billion cubic feet per day. But readers should expect producers to bring on tills now. Production should start to ramp by the end of October. You can see this coming on back here over the past few months for natural gas production in the lower 48. Lee Groman says the chart below suggests one of two things. There is no recession coming. If anything, the economy is already in recovery mode. And number two, the key marginal driver to U.S. consumer spending, GDP, and therefore receipts are U.S. stock prices, not activity in the real economy. Let's watch, in his opinion. So this is the year-over-year change in trailing 12-month U.S. Treasury receipts. And a lot of receipts come from the stock market and the gains from the stock market. So that's one thing to watch. Heads I win, tails I don't lose much, says Manish Pabri, and that is asymmetry. Asymmetry is heads I win, tails I don't lose much. Steve Donza, he says global PMIs to find their footing as rate cutting cycle breadth broadens out. Of the 30 major central banks, 17 or 57% are easing, 10 of them or 30% are holding, and only 3, 10% are tightening. And what we see here is this is a lagged easing effect, is what this is called. It's the share of global central banks' net easing policy rate over last 6 months versus global manufacturing PMI. So we go into these easing cycles that started 2024 here. The global manufacturing PMI follows that easing cycle with a lag. It's a little bit of a lag. So we've got a little bit of a lag here. The easing cycle is underway, and we should probably see global manufacturing PMI kick back up. That would be my guess. Investment wisdom, here's a couple of quotes. There are two requirements for success in Wall Street. One, you have to think correctly, and secondly, you have to think independently. Benjamin Graham. And here's another one. If you are honest, hardworking, reasonably intelligent, and have good common sense, you can do well in the investment field as long as you are not too greedy and don't get too emotional when things go against you. Walter Schloss. I put this into an AI one. It says this might help some people figure out market conditions and economics, more of an engineering approach. What I put in there was solving problems with the given information. What that means is it's an approach. It means to approach a problem by carefully analyzing and utilizing only the details provided without making assumptions or seeking additional information beyond what is explicitly stated in the problem description. Essentially, using the facts presented to logically arrive at a solution. The key steps involved are identify the problem, so you clearly understand what needs to be solved by carefully reading and interpreting the given information. Extract relevant details. Highlight the key facts, figures, and conditions mentioned in the problem statement. Analyze the information. Look for patterns, relationships, or logical connections with the given data. Apply appropriate strategies. Depending on the problem type, this could involve calculations, logical reasoning, decision making, or using specific formulas. And then check your answer. Verify that the solution aligns with the given information and makes logical sense in the context of the problem. So what I do is this is how I approach problems in the market. If someone says we are going to have a huge housing market crash, I look at inventory data. I look at what the home builders are doing. I look at housing starts. And then I try to form an opinion based off of the data and the facts that I can find. And if they don't match the opinion that is given to me, then I would say I don't agree with that opinion because the facts tell me otherwise. So in order to look at the markets correctly, like this quote up here, there are two requirements for success in Wall Street. One, you have to think correctly, and secondly, you have to think independently. That is tied to solving problems with the given information. You have to look at the problem, analyze the problem, and then draw correct conclusions from the facts that are given to you. If you don't do that, you will not be successful in investing because you're drawing the wrong conclusions from the data. And just because you draw the correct conclusion doesn't mean that the market will figure it out quickly. It might take time. So you have to really lean on your critical thinking skills and your ability to draw correct conclusions. Even in the face of people disagreeing with you, you may be right, but you might not be right immediately. The markets take time to price things differently. And people have to come around maybe to the way that you're viewing something. Here's another quote from Mani. She says, regardless of the quality of the business, no business should be purchased above its intrinsic value. Buying a business above intrinsic value is not investing, it's gambling. So these guys are hardcore value investors. He wants to find good deals. Here's the metals weekly performance for last week. Nickel was up quite a bit, 3.43%. Copper is second, silver third, gold fourth, and making an all-time high. The laggards are platinum, zinc, molybdenum, and uranium was slightly lower. So platinum was the loser. And you know what I would buy? I would be looking at platinum right now because that's the one. Now, am I buying it because it was down? No. I would buy it because it has a good chart pattern. And I chase chart patterns. I don't chase price movement. Alberto says, on the 2nd of July, I wrote an almost 40-page report on my free blog about uranium and nuclear energy. On a page, I argued how AI could boost demand for uranium. Today, we learned that CEG and Microsoft have struck a deal to resurrect a unit of the 3 Mile Island nuclear plant. And this is what's coming for data center power consumption by providers and enterprises in gigawatts. Huge move higher for data centers power consumption. Big. This is a CAGR is the compounded annual growth rate, 13% per year, 12, 10, and about 9. So big growth going on for energy. Now here's another thing to think about too. As this energy grows and how fast this is growing exponentially. So when we keep going, this could go up massively. So when you start to look at the year over year demand requirements, they are huge movements. If you're moving at a 9 or 8% clip, I'm curious to see just how much energy we have out there. Because if this starts to go vertical, where artificial intelligence really kicks it into high gear, and this is only one aspect. This is the power consumption to do work with, to make decisions with, so to speak. But if AI makes decisions and things become more efficient, I think energy in general could continue to ramp at a very fast pace because energy is GDP growth, and they're doing AI to grow GDP. So if GDP grows rapidly, you need a rapid expansion of energy. And I think energy investments could do incredibly well in this environment. The key to save as much as you can as early as you can. That's the key, is saving as much as you can as early as you can. Grady says the ratio silver miners to silver shows a very nice setup now. This is SILJ versus SLV, and it looks like it's trying to bottom and turn higher here with an inverted head and shoulder. He calls it the end around the apex move incoming. Also, this move will be an epic move. He says here we bought larger silver producers at the service. I bought the smaller guys. Slingshot move. He's got the slingshot going on. I like it. I like the slingshot. And that's all I've got for today, guys. So give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. And we'll catch you guys later. This is Finding Value.